For most investors, the S&P 500 through ETFs like VOO or SPY has become the golden standard. It's easy, familiar, and carries the prestige of owning the 500 biggest US companies. But let's be honest for a second. The S&P 500 isn't the final answer. If VOO is so perfect, why do dividend investors keep piling into SCHD? And why do growth investors worship SCHG? Is there something VOO lacks that these ETFs provide? Let's dive deeper into this. See, VOO is like ordering a combo meal. You get a bit of everything, a little growth, a little income, and a whole lot of market exposure. But what if you could handpick the two best ingredients from the S&P 500 and skip the filler? That's where SCHD plus SCHG come in. One pays high-quality dividends. The other chases aggressive long-term growth. And when you blend them together, strategically, not randomly, you might just outperform V or O, with more income and sharper focus. So consider this dynamic duo for a balanced, powerful portfolio. So in this video, we're diving deep. How does SCHD plus SCHG really stack up against VOO? Is this two ETF strategy better for income, growth, or both? What's the risk trade-off? And is this combination recession-proof or just another shiny object? Let's break this down. We'll cover all this and more in today's video. Before we compare, let's understand who's on the field. SCHD, SCHG, and VOO are key players in the ETF arena. VOO, the S&P 500 workhorse. VOO mirrors the S&P 500. It owns 500 of America's largest companies, weighted by market cap. So tech giants like Apple, Microsoft, Amazon, and Nvidia sit at the top. Expense ratio 0.03%. Dividend yield around 1.4%. Top holdings: Apple, Microsoft, Nvidia, Amazon, Meta. VOO gives you broad exposure with low costs. But because it's cap-weighted, the top 10 stocks often drive the majority of returns and risk. This makes VOO a solid choice for long-term investors. SCHD, the dividend powerhouse. SCHD, the Schwab US Dividend Equity ETF, is no ordinary dividend fund. It's built on quality, profitability, and consistency. Dividend yield around 3.6%, variable but typically high. Expense ratio 0.06%, screened for consistent dividends, strong fundamentals, high return on equity, top holdings: Verizon, Broadcom, Texas Instruments, Amgen. Think of SCHD as your portfolio's cash flow machine. It rewards you for holding through growing dividends from strong companies. It's not just high yield, it's smart yield. SCHD's performance has been impressive, consistently outpacing many of its peers. With a focus on strong fundamentals and reliable dividends, SCHD is a cornerstone for any dividend-focused portfolio. SCHG, the growth engine. SCHG, the Schwab US Large Cap Growth ETF, is like the hypercar of the group, engineered for speed. Top holdings include Apple, Microsoft, Nvidia, Amazon, and Alphabet. It has an expense ratio of 0.04% and a dividend yield of around 0.4%. The focus here is on momentum, revenue growth, and innovation. It leans hard into tech and growth sectors. So when the market rallies, SCHG can rip higher than VOO. Let's talk results. How did SCHD and SCHG hold up against VOO over the past decade? Assume a 50-50 blend of SCHD and SCHG rebalanced annually. Total returns from 2013 to 2023 show that SCHD and SCHG combined at 50-50 achieved approximately 13.5% compound annual growth rate, while VOO achieved about 12.7%. That's roughly 0.8% better per year, which may seem small until you zoom out. On a $100,000 investment, VOO grows to around $332,000 after 10 years, whereas SCHD and SCHG grow to about $356,000. That's a $24,000 difference with the same number of ETFs. Income growth or dividends. VOO pays around 1.4% yield, steady but light. SCHD alone pays 3.5% or more and has a track record of dividend growth. Together, SCHD and SCHG offer around 2.0 to 2.4% yield on average. Here's the kicker. While SCHG isn't known for yield, its capital gains can be harvested periodically to supplement income. So, over time, this combo lets you enjoy higher immediate income, benefit from faster portfolio growth, and maintain tax efficiency through qualified dividends and capital gains. Let's address the elephant in the room. Aren't SCHG and SCHD overlapping with VEO? If so, why not just stick with VO? Overlap breakdown. SCHG overlaps about 36% with VO. SCHD overlaps around 20% with VO. SCHD and SCHG overlap with each other by less than 5%. Translation: SCHD plus SCHG equals broader factor exposure, not redundancy. SCHD gives you value, cash flow, and dividends from financials, industrials, and healthcare. SCHG loads you up on megacap tech, innovation, and momentum. You're not doubling up. You're diversifying your factor exposure while avoiding the middle-of-the-road MA stocks that weigh down VOO. Now let's talk risk management. During sharp corrections like in 2020 and 2022, SCHD held up better than VEO due to lower volatility and defensive sectors. SCHG dropped more than VEO but also bounced back faster in bull runs. Blended together, SCHD plus SCHG has shown lower max drawdown than SCHG, faster recovery than VOO alone. So while VOO gives you smoother average rides, SCHD plus SCHG lets you dial risk up or down based on your weighting. Want more stability? Go 60% SCHD, 40% SCHG. Want more upside? Flip it to 40% SCHD, 60% SCHG. During downturns, dividend income can act like your safety net. SCHD shines here. Many of its companies have continued paying and even growing dividends during recessions. Meanwhile, SCHG's low yield means you can tax loss harvest more easily when needed. Also, because SCHD pays qualified dividends and SCHG offers capital appreciation, the combo may be more tax efficient than VOO's middle ground structure, especially in taxable accounts. Let me show you how two investors use this approach differently. Investor A, early retiree, age 45, allocation 60% SCHD and 40% SCHG, goal dividend income plus principal growth. Result: covered 50% of annual expenses with dividends, reinvested SCHG growth during bull years. Investor B, wealth accumulator, age 28, allocation 70% SCHG, 30% SCHD, goal maximize capital appreciation. Result: rode the 2020 to 2021 rally with SCHG, then added more SCHD for stability during 2022 to 2023. Both beat VOO for their specific goals, because they tailored the ratio to their risk tolerance and timeline. So, is SCHD and SCHG better than VOO? It depends. If you want simplicity, autopilot investing, and don't care about yield, VOO is still fantastic. If you want to boost income, sharpen growth, and target specific factors, SCHD and SCHG give you more control. This isn't about saying VO is bad, it's about unlocking the engine underneath the hood. By separating growth and dividend factors, you gain flexibility. You can tilt toward offense or defense. You can customize your ride without reinventing the wheel. Final thoughts. The new lazy portfolio. We often hear about the 3-fund portfolio. But what if the next evolution is a 2 ETF combo? SCHD Cash Flow King, high-quality, dependable, income-generating SCHG Growth Champion, tech-heavy, aggressive, built for compounding. Together, they form a growth and income powerhouse. And in many backtests, they've outperformed VOO without requiring more complexity. So here's the question. Are you settling for the market average with VOO or building your own version of excellence? Now I want to hear from you. Are you Team VOO or Team SCHD and SCHG? What's your ETF combo for long-term wealth? Drop your allocation strategy in the comments. I reply to every serious portfolio breakdown. And if this gave you clarity, smash that like button, subscribe for more no-fluff ETF strategy breakdowns, and I'll see you in the next one. Peace. In this new chapter, we will delve deeper into the benefits of combining SCHD and SCHG ETFs. We'll explore historical performance, potential future growth, and how this combination can fit into different investment strategies. Stay tuned for more insights and expert analysis.